what would you say constitutes sound money?
Well, the public has confidence in the currency, which they do, which the world does. That's really what it comes down to, that people believe that the United States currency is perfectly reliable and stable in value.
Hello, welcome back. Today, I'm gonna give a very unscientific and very unprofessional opinion on what's going on the market. Now, why do I say unprofessional? Because I'm not a professional in that matter. That doesn't mean I have nothing of value to add. So I'm gonna tell you what the actual interest rates are in the United States according to the official statistics. We're gonna compare them with some other markets, and I'm gonna explain why, in my opinion, money is leaving the US dollar and moving to other currencies and other government bonds. And this is the reason, one, for the rising interest rates, and two, for the sell-off in the stock market. In the US, what we had is last year in March, in the middle of March essentially, the country started shutting down. As soon as this happened, the Federal Reserve lowered the interest rate. So in February, the interest rate was 1.58. We're in February 2021 now. And then in March was 0.65, and in April was 0.01. What I want to bring to your attention is the cost of having money. And when I say money, I don't mean $1,000 that you can put in your savings account. Actually, big amounts of money belonging to pension funds, corporations, wealthy individuals, hedge funds, if you will, that you cannot just put in a bank and count on the FDIC to come and save you if something happens to the bank. Before 2008, for you to have to keep your money in the bank officially more than inflation. So for example, if the interest rate was 5%, your savings account would give you 5.5%. This is because the Fed's idea has always been less inflation until very recently. February last year, interest rates 1.58, and let's look at inflation. Inflation for February last year 2.3. So you were paying essentially about 0.6% to give your money to the federal government to hold on an annual basis for, let's say, 12 months. So for 12 months, if you wanted to have money in a safe place, because you can't dig a hole for $100 million, and if you want to know why, ask Pablo Escobar, you need to keep it somewhere official. Well, you gotta pay for that. And then what happens this year? This year, let's say in March, from 1.5 to 0. At the same time, inflation is going from 1.5. Essentially, last year in March, if you kept your money, if you gave your money to the federal government for a year, assuming nothing changes, you're breaking even over a 12-month period. You get 1.5% back, and you get the inflation of 1.5%. So your money didn't lose value. Now, this year in March, if you gave your money to the federal government, you get 0 interest rate with your bonds. And that's how you give money to the federal government. You buy bonds, you buy treasuries. And meanwhile, in that 1 year, your inflation, basically how much you're going to lose on annual basis, how much your money is going to lose value on annual basis, is about 4%. 3, 4, doesn't matter what the actual number is, but it's going to be above 2. And I'm going to tell you why this is important now. We're going to look at the European Union. European Union inflation 2020 was 0.38%. That the euro area is where you would keep your money. Basically, let's say you want to give it to the German government, they're a euro government. So inflation was 0.38%. Pretty low. But at the same time, interest rate is 0. So when you give your money to the federal government, to the government of Germany or any euro government, you are effectively losing 0.38% on annual basis, and that's the cost for you to have your money held by the German government. In the US is 0.5%, and in the European Union is 0.4%. Not a big difference. Then we look at what happens in March 2021. Well, in March 2021, euro area inflation is going to be about a little bit under 1%, and the interest rate is still 0. So if you give your money in March to the German government, March of 2021, you're willingly telling the German government, here's my money, I'm gonna get 1% less a year from now. At the same time, if you do that with the US government, you're willingly telling them, here's my money, I want you to keep 2.5% next year. This is how inflation and interest rates are actually seen by people with money. Let's look at Switzerland. Negative 0.077. So basically, you were making money if you deposited in Switzerland because the inflation was negative. Basically, your money was becoming more expensive. But at the same time, your interest rate is 0.75. So, in effect, if you give your money to the Swiss government, you're at 0. That's just a few examples of the difference we're gonna be having starting March 2021 with other major economies. And I'm not putting Switzerland as a major economy, I just gave it as an example. We also have Australia, Canada, New Zealand, Japan, if you will, even though Japan is pretty much in the same boat as we are. So if you had liquid money that you could move in February, and you already know what the statistics will be for March, you know we're going to have 2.5-3% inflation. That means April, May, June, even July. We're going to have high inflation, and according to our dear leader Jerome Powell, the man with the printer, we're going to keep the interest rates at 0. So if you give your money to our US government at 0% interest rate, you're basically accepting 2.5% loss. Best case scenario. And why do I say best case scenario? Well, at the same time, they've promised, and they actually voted last night in Congress to issue another $2 trillion from the federal government. And as soon as they did that, they started talking about another package of $3 trillion. That is on top of the 40% of dollars ever created to be created in 2020. So giving your money to the US government to hold for safety, it's starting to become more and more expensive. So naturally, you don't want to give it to the US government. What happened until now? Well, you put it in the stock market. You give it to Apple, which from $1 trillion became a $2 trillion company, and even more. You give it to Apple, to Microsoft, you buy their bonds, which in this month also effectively went negative due to their high demand. Their yield kept getting lower and lower, so they're basically lower than they're also going in negative interest rate. So until February, that was a good point. But then you start looking around in February. You know how inflation officially is going to look like in March. You know the interest rates are not going to change because the Jerome Powell has told you that. And you know for a fact you're losing 2.5% in bonds. At the same time, stock market is at all-time highs. Regular blue chip companies like Apple that are not supposed to double in a year have more than doubled in a year. They went from $1 trillion to $2 trillion, and you're thinking, well, the risk is really high in the stock market. I know I'm losing money in the bonds. If I'm going to pay a government, let me pay less. Let me give it to the Australians. Let me give it to the Germans. Let me give it to the Swiss. I'll lose 0.5% a year, but my money will be liquid. And if I see a good investment opportunity, it's easy for me to move. So, in my opinion, this is what's happening now. The reason why interest rates rose is because people didn't bid on the bonds. They didn't bid because there are no dollars in the system. Not that there are no dollars, but there are less people interested in keeping dollars, where you could keep them in Swiss francs, in euros, in Australian dollars, or anything else. And when this happens, all the stocks, especially the ones that are just stocks, companies that have been for a while, all of their prices, basically their DCFs, and I don't want to get into the details of that, are calculated based on the interest rate. When the interest rate goes up, the price goes down because they become more risky. So the money leaves. It goes to euros, it goes to Swiss francs. It just basically leaves the dollar. If you think about what I just said, this is what's going to be looking like for the next 4 months. March, April, May, June, July. And I just want to tell you, what I've given you so far is basically facts. From that point on, is what I'm giving you is my opinion on what's going to happen. So my opinion on what's going to happen is this. As soon as the US Senate decides to vote on this stimulus package, and it's actually voted, and Joe Biden signs it into law, all of the downside into being in the US is capped. There's no more wars. We're going to have another 3 trillion on top of the umpteen trillion that we printed over the last year. It's not that big of a deal. That's not even the important part. The important part is that other countries are going to experience something that they don't like. When money leaves the dollar price goes down. So currently the dollar index is at 90. Let's say it goes down to 80. That's about 12% decline. What that means is if you have any other currency, let's say on average, if you have any other currency, your currency became 12% more expensive versus the dollar. Well, the US is the biggest importer of stuff. And when everything against the US goes 12% more expensive, we stop buying that much stuff. What that means is, as soon as the $2 trillion package is signed into law here, you will see other countries immediately moving with their own stimulus package, essentially trying to outprint the US government. So their currencies are cheaper versus the dollar. If their currencies are expensive versus the dollar, their exports to the United States become more expensive, and we buy less stuff. When we buy less stuff, essentially when we have a crisis here in the US and we buy less stuff, we export that crisis to whatever country we're importing from. This is the beauty of having a reserve currency, because everything has to be transacted in dollars. If we're gonna have a high number of inflation here in March, I guarantee you, and again that's my opinion, you're gonna hear about stimulus packages in Europe, in Canada, in Australia, in any country that's dependent on US exports. And it's gonna be a race to the bottom. It's not gonna be just the Australians printing money. It's gonna be everybody printing money, trying to at least match what we're printing here. And I say at least. It might be more, because their goal is for their currency to be cheaper than the US, or getting cheaper all the time, so their exports don't get hurt. So we're gonna see a very coordinated effort in March between central banks. I don't know what the name of the UK central bank is, but whatever the name is, they're gonna start stimulating. The EU is gonna start stimulating. Canadians are gonna start stimulating. Australians are gonna start stimulating, and the pretense will be something to the tune of, oh, we have the virus under control, the economy is screwed, we gotta make something happen, so we're gonna give the people money in one form or another. So they're gonna start printing. They're gonna print with the whole purpose of their currencies going back to some kind of equilibrium where we keep buying their stuff. So when it comes to the market, what I expect will happen, once the other governments start talking about printing money, not passing the laws, just talking about printing money, we're gonna have the opposite effect. We're gonna have money coming back to the US dollar. The interest rates are gonna go down again. They actually might turn negative officially, but that will take a while. And the stock market's gonna start rising. And like I said, let's say Joe Biden, let's say the stimulus package gets to Joe Biden's desk on March 10th. It gets there, he signs it. By March 15th, you're gonna hear Christine Lagarde and Kristalina Georgieva, who is the IMF chief, Christine Lagarde being the ECB chief. They're gonna start talking about stimulus in Europe. You're gonna hear it in Canada, you're gonna hear it in Australia, and any other country in the world that deals with the US. And when they start doing that, it's gonna be a wave. But the whole point is this. In my opinion, by the end of March, we're gonna have a very rocky March if you're in the stock market. If you're in Bitcoin or gold doesn't work very well with high interest rates. But as soon as interest rate starts going down, gold is gonna shoot up. So if you're in gold, or if you wanna be in gold, in the next 2 weeks it might be your best period to get into gold. Same thing about Bitcoin, because I think they're trading basically the same, but Bitcoin being more volatile. And then stock market is gonna start getting back up. We're gonna have a very choppy month in March. My prediction is the S&P 500 would be at the end of March March 31st, within 3% of where it is today. Might be 3% negative, might be 3% positive. That wouldn't be that important, but it's not going to be a huge move either direction. And 3% might be even too much what I'm giving you. But the whole point is this. If you think that you can sustain another 5 to 10% losses on your stock market portfolio, go ahead and hold. If you have money and you're waiting to get in, I wouldn't get in the stock market now. I'd get into gold. But getting into the stock market the last weeks of March could also be very profitable. Again, this is my opinion. I'm not a professional. I'm just trying to tell you and explain how I think about money, especially how it's tied to politics and how things flow. I hope this is very useful for you. And then you're going to click the like and subscribe button and you're going to leave me a comment. For the first time last week, I had a dislike. Whoever did that, I appreciate it very much. If you find any value in what I'm talking about, share it. It helps me. But that's it. Thank you very much. Have a good night.